If you have a business loan, a line of credit, or a credit card balance, the interest you pay was supposed to drop this year. And this video shows you the 4 moves to protect your business now that it is not. Everyone told you interest rates would fall this year. The Federal Reserve just made it clear they are not. And the bigger story is what comes next. Because the smart money has stopped betting on cuts and started betting that rates could go back up. Did you know the Fed just held rates steady again, instead of cutting them? Did you know markets have now flipped to betting the next move is a hike, not a cut? 6.75%. That is the prime rate your business borrowing is built on, and the cuts that were supposed to bring it down are gone. At its June meeting, under its new chair, the Fed held its benchmark rate at 3.5 to 3.75%. Oil spiked past $110 a barrel this spring. Inflation climbed back toward 3%, and that combination took rate cuts off the table. By the end of this video, you will know the 4 kinds of debt this hits, the trap that careful owners are walking into, and the 3 moves to protect your cash flow before rates climb. Stay to minute 4 for the move nobody is talking about. So here is what actually happened. For 2 years, business owners were promised that rates would come down in 2026. Then prices started rising again, and the Fed's new leadership decided it could not risk cutting into fresh inflation. So they held. And for the first time in a while, the people who trade on these decisions are now pricing in the chance that the next move is up, not down. What changed their mind was simple. When prices are climbing, cutting rates pours fuel on the fire, so the Fed chose to hold the line on inflation instead of handing borrowers the relief they expected. Read this part twice. Most business debt is not fixed. It floats with the prime rate. Your SBA loan, your line of credit, your business credit card, most of them move up and down with the Fed. When everyone expected cuts, floating felt smart. Now that bet has turned into a risk. Here are the 4 kinds of debt that feel this directly. 1. Bank and SBA loans priced at prime plus a margin. When prime stays high, your payment stays high, and the relief you were counting on never arrives. 2. Business lines of credit. These are almost always variable, so every dollar you carry costs more than it did when cuts looked certain. 3. Business credit cards. Their rates track prime too, and they are usually the most expensive money you carry. 4. Variable rate equipment and term loans. If you financed a truck, a machine, or a build-out on a floating rate, a hike raises that payment for years. And because those loans often run 5, 7, even 10 years, a single rate increase quietly raises every payment for the rest of the term. And here is the part that should make you stop the video. The trap is waiting. Thousands of owners put off borrowing or refinancing, telling themselves they would do it once rates dropped. That drop is not coming on the schedule they expected. Waiting for a cut that is not coming means 2 things. You keep paying today's high rate on the debt you already carry, and you risk losing the chance to lock a fixed rate before the next move pushes it even higher. Here is the move nobody teaches. Stress test your debt at a higher rate. Take your variable balances, add 1 or 2%, and see what the payment becomes. If that number would break your cash flow, you do not have a rate problem someday. You have a structure problem today, and you fix it now. Quick reset for anyone just jumping in. The Fed held rates, the promised cuts are gone, and the next move could be up. Most business debt floats with prime, so waiting for relief is now a risk. Here is exactly what to do. Before I show you the 3 moves, let me give you the 1 rule that protects your business in any rate environment. Quick favor, if this is the first video that explained what the Fed's decision actually does to your business, hit that like button and drop a comment below. I read every single comment and reply personally. Share this with any owner carrying a loan or a balance. And don't forget to subscribe. We put out several new videos every week. Drop a comment. Is your business debt fixed or variable? If you are not sure, type not sure. I want to see how many of you are exposed to this. Okay, here is exactly what to do. 3 moves. Move 1. Lock fixed wherever you can. If you are taking on new debt, choose a fixed rate over a variable one. even if the starting rate is a little higher. And ask your lender whether your existing variable loans can be converted to fixed. Locking removes the risk of the next hike entirely. Watch this part carefully. First, you have to know which of your loans is which. Pull every loan and line you have and label each one fixed or variable. You cannot protect yourself from rising rates until you know exactly where you are exposed. Move 2. Attack your variable debt first. Put your extra payments toward the floating balances before the fixed ones, starting with your business credit cards and lines of credit. Every dollar you knock off variable debt is a dollar that can never be repriced higher. Here is why that order matters. A balance sitting on a variable card at over 20% costs you far more than the same dollar on a fixed loan. So clearing the floating debt first protects you twice, from today's rate and from the next hike. Most channels miss this. Your SBA loan is almost certainly variable. A lot of owners assume it is fixed because the payment has felt steady, but it is tied to prime, and it has been quietly climbing. Check the rate type on that loan today. Move 3. Stop waiting for cuts to make your move. If your business needs capital, the cheapest day to borrow may be now, not some future date when rates are lower, because that date keeps moving. Get the funding you need, lock the rate where you can, and structure the payment to survive a higher rate world. Let me bring it all together. The Fed-held rates, the cuts you were promised, are gone, and the next move could be up. Most business debt floats with prime, so the relief many owners were waiting on is not coming, and waiting has become the risk. The one rule that beats all of it: plan for rates to stay high or rise, never for a cut that is not coming. Lock fixed where you can. Pay down your variable debt first. And stop delaying the borrowing or refinancing your business actually needs, because the rate you are waiting for may never show up. Here's what to do this week. List every loan and line you have, and mark each one fixed or variable. Add 2% to the variable ones and see if the payment still works. If it does not, call your lender about locking a fixed rate now. 10 minutes this week can protect you from years of higher payments. One last thing before you click off. And if high rates are squeezing you, there is a smarter way to fund your business than an expensive advance. The SBA just made a simple line of credit far easier to get. I break it down in the next video. If this video helped you, please give it a like and leave a comment. I read every comment and reply personally. Send this to any business owner carrying debt, and make sure you subscribe, because we put out several new videos a week, all free. And the next video you should watch is the new SBA line of credit that makes working capital simple to get, a real alternative to a cash advance. Subscribe so you don't miss it. See you there.